Yes, we are going to talk about our favorite stocks here in this video, go over the Ortex data, the things that we usually cover. But the stock market crash just went from bad to worse and got substantially worse here on the day. That is why the S&P is down almost 2.5% and the Nasdaq is down about 3%. So I want to get into all of this information. We do have another major catalyst coming next week, and these two things are really feeding into each other and creating a really bad overall market dynamic. So let's dive into all of this information. If you guys find value out of this video, hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section, and make sure to go ahead and get yourself that free stock with Webull, Moomoo, and Public. Now, without any further ado, let's get into this video. So what really happened today and what brought down the markets, if you guys have not seen it yet, it is the CPI report that came out today. So inflation rose 8.6% in May, highest since 1981. The consumer price index rose 8.6% in May from a year ago, the highest increase since December 1981. Core inflation, excluding food and energy, rose 6%. Both were higher than expected. Surging food, gas, and energy prices all contributed to the gain, with fuel oil up 106.7% over the past year. Shelter costs, which comprise about 1/3 of CPI, rose at the fastest 12-month pace in 31 years. The rise in inflation meant workers lost more ground in May, with real wages declining 0.6% from April and 3% on a 12-month basis. So what this report really showed, and what you can bottom line this down to, is inflation is branching out. It's moving into different asset classes. It's also moving into more of the services. Now, what we've seen the last time around, and last time around I mean high inflation, 70s, 80s, it was really in a lot of goods, right? The cost of things kept going up. Well, what we're seeing now is the cost of things went up, very, very fast, like we've seen in the 70s and the 80s, but now the price of services is also going up, and that can be very, very sticky, like your doctor rates, probably not going to go back down after they go up, right? That Disney ticket, probably not going to go down that fast. So you're seeing inflation really branching out, and what this ultimately did for the Fed is it's saying, hey, you guys probably can't stop or slow down raising rates in September. That's what the markets have been looking forward to, is, hey, if inflation comes down, if things can start looking okay, then the Fed can stop raising rates in September, or at least slow down in a big way. And that is completely off the table. That's not going to happen. Now people are talking about a 75 basis point or a 1% rate hike coming at future meetings, and that is starting to get priced into the federal funds rate, or the projected federal funds rate, I should say. Now, if we look out to December, most participants in the markets are expecting a federal funds rate in between 3 and 3.25%. Guys, the federal funds rate is currently at about 0.75%. So that would be a pretty decent move to the upside. And it's a range, so 0.75% to 1%. That's where we're currently at right now. And that would be, implying 50 basis point rate hikes as well as a 75 basis point rate hike from now until December. So we started to see the federal funds rate actually calm down and to start pricing in less. And now we're pricing in more. So what does that mean for long duration? Well, long duration growth stocks is exactly how it sounds, long duration. So if you're buying something like a SoFi, a DraftKings, a Affirm at the market value now, you're hoping that company is much bigger in the future. That is long duration growth. So when you start to get this expectation of, basically capital becoming a lot more expensive, those growth companies that aren't necessarily profitable are going to have to borrow money, and it's going to cost a lot more. At the same time, it looks like inflation is going to be higher for longer, so that also drives down the real potential profits these companies will make in the future. It makes the dollar less valuable. So really not a good situation overall for long-term growth stocks. And why it's going to be so interesting over this next week or even the next couple of weeks is where the markets are at, as well as the catalyst for next week. So if we look at the S&P 500, it was definitely a gap down almost 2% here on the day, coming to the lower end ranges. We have not closed this low too many days. You guys can see the wicks are pretty low, but the closes here have not really been in the low 390s. We closed right here at 389, and we had hit that low at 380. We closed right here at 396, closed right here at 393.89. We have not closed at these levels yet here in 2022, besides right here, and that was on May 12th. We actually did close at 392.34. So we're approaching the lowest closing price on the S&P 500 of 2022. And that's not going to be a good sign. If we sell off into the end of the day, the last couple of minutes here, that's going to be no bueno. So you're in a really weird situation as far as actual price action on the S&P 500. And then we have the Fed meeting coming next week. The Fed meeting is in 5 days, 49 minutes from now. And that will be on June 15th. That falls next Wednesday. So I think, Monday, Tuesday, those could be pretty fearful days in the markets. I would expect a little bit of a bounce back, but if we sell off into CPI, or not CPI, but the Fed, we might get a bounce. But depending on what the Fed says, if they just come out and raise more aggressive than 50 basis points, or kind of tell us they're not going to slow down, the markets might have a little bit of a fit over that. Now, as well as that, if we do go ahead and look at the bond yields shot up today in a very dramatic way. The bond yields are now at 3.15%. That is up 0.1% on the day. That is a colossal bond move. That does not happen. Normally, that does not happen. This looks like a momentum stock. Just yesterday at 3.04%, we're now at 3.15%. It's a massive move. And it's definitely going to push the price down of especially a lot of growth stocks. So that's what is really happening today. Bond yields destroying the markets. CPI destroyed the markets. And I think there's this expectation that the Fed might rug pull us, and that could also destroy the markets for next week. So that's really what we have to contend with. That's going to be the main catalyst. That is what is happening. We'll dive into other things that can affect the markets, over this weekend, and really try to figure out what potentially is the most likely outcome for these next couple of weeks. But it doesn't look pretty right now. It doesn't look pretty at all. You're starting to see layoffs. You're starting to see companies cutting guidance. At the same time, inflation is high. The Fed is raising rates, heading into a recession. It's almost a perfect storm for not only volatility, but the market's staying down for a considerable amount of time. So before we switch topics and talk about our favorite stock, I want to leave it off on this one word, because that was a lot of negativity just brought to you guys in a very short amount of time. Take this opportunity to solidify your long-term future. If you are over here buying the dip in quality stocks that will make it through a recession, you can come out on the back end of that with a massive position in some of these companies that could balloon for you. And that's what I want to see happen. So at least for you guys, if that's what you want. I mean, if you're watching this video, hopefully you want to make some money. But nonetheless, let's get into the other information we have to cover about our favorite stock here in this video. So for the day, AMC is down about 3.41%, which is actually a pretty good day considering the NASDAQ is down almost 3% as well. So it's not like an abnormally big move to the downside, which is certainly a better thing than not, but it's still not a positive day. And I know people are concerned about the executive order, concerned that things are not going the way that it looked like they would, but I would just keep in mind that all good things will come to fruition in the end, and I have 100% confidence in what I say, at least here on this channel, and we're in there like swimwear, baby. We're in there so we don't miss it, because it's going to be very explosive when it actually does happen. Now, if we're looking at this on a technical basis, we have not done anything, so please relax. I know some people are saying, AMC's dead, Redbox is the only trades, things like that. Don't even listen to them. Yes, we've been up and down. Today we are down. Tomorrow or next trading day will probably be up. But we really have not done anything. In between $12 and $14 per share as of recently is where we are a majority of the time. We're almost lined up with the max pain for this week, which is $13 per share. I will say the max pain for next week is $18 per share. So that's something potentially we could look forward to. We lined up this week. If we line up next week, that would be a pretty substantial move to the upside. Now, if you're looking at the RSI, not looking so pretty, 45.11, so that it's definitely on the oversold side. The MACD, surprisingly, is somehow still bullish, but we do have very low volume for the day, sitting at about 23 million shares that have traded hands as of right now. If we do take a look at the Ortex data, some very weird things happening here. Free flow out on loan has increased about 1% over the past 24 hours, but the short interest looks like it went down about 1.6% over the last 24 hours. So something is not right here, and I do think Ortex just has their numbers wrong, and the short interest is really much higher. If you factor in all the market maker shorts that they have to put on the market, or put on the stock, I should say, because of all the puts that are running into the money, that's a substantial amount of short-term short interest on AMC. But the short interest of free float reflected to us as of right now is 22.4%, which is still very, very high. Current shares that are sold short of 115.49 million, cost to borrow average of 19.15%, cost to borrow max of 26.21%, 100% utilization. Like I said, free flow out on loan about 37%, days to cover at about 3.67. The option activity very, very bearish on the day. Look at this order though, January 19, 2024, $90 call for about $45,000 coming through. That's a very interesting position. But nonetheless, 9 orders on the day, totaling $2.2 million, positive order value of 5%. So not looking all too pretty. But again, it will come a time where AMC will see that momentum, and all of these things are going to work to our benefit, right? All of the negativity, all of the short interest, it will eventually work to our benefits, but you just have to wait until that actually happens. Now, for this next upcoming week, you have about 7,000 calls that are in the money, 327,000 calls that are out of the money, 120,000 puts that are currently in the money. So a lot of potential buying power that could come from the option chain next week. We'll see if that happens. We'll see if it flips, but that's a lot of puts that are in the money, and that's a lot of calls that are out of the money. So that is pretty much going to be all for this video. That is what you guys need to know. Nothing spectacular to report here today. Just a really chill day, I would say, overall for at least AMC stock relative to what the markets are doing today. So that is going to be it, ladies and gentlemen. Thank you guys for watching. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for watching. Enjoy the rest of your weekend, and I'll see you in the next one.